Hey everyone, there is a heightened recession fears across the globe. In everyone's mind, if you take a fear gauge indicator, it is on the extreme fear zone. People are scared. People are looking for safer places, safer haven to hide. Because there is heightened uncertainty due to the energy crisis. In Europe, there is lockdown extension in China, which is bottlenecking the supply chain. There is US mortgage rates that's touching almost 7% record high. And there is all around central banks fighting the inflation and a possible recession. Now, the recession is imminent. Whether it is a mild recession or a deep recession, we need to prepare for that. We need to find places to invest and protect our portfolios. How do we do that? How do we prepare for this in upcoming recession? Here are some of my thoughts which could potentially sound counterintuitive. Most people are asking me why not invest in bonds because they are yielding 4-5%. And potentially the high risk yields around 7-8%, 9%, right? And there are also real estate that is looking pretty stable at this juncture because the prices haven't started falling that much, although they have. Now, you take the different type of markets, the equity markets looks the most riskiest because they have fallen like 70-80%. And people are just running away, throwing the towel in. Now, what exactly people should do to beat inflation? How do one invest in a portfolio that can beat inflation over long term? Now, we need to study from history when these things have happened previously, like in 1980s, like in 1990s, 2000, 2009, crashes has happened all around. Recessions have happened previously. So we need to learn from history because they rhyme. So what I would say as a best possible way to handle this kind of a scenario is to look at the asset class that can beat inflation over long periods of time. Although real estate might look attractive at this juncture because they are kind of stable compared to equity markets, here is what you need to understand. Stock market is a leading indicator of an economy. It's a leading indicator of a recession. But potentially, whenever the recession has happened, it is preceded by a high stock market up move, sustainable up move, and that keeps going up and up as the recession starts catching up. So it's a leading indicator. Whereas the real estate markets and many other markets out there, many other assets could potentially be a lagging indicator, right? It might lag the actual economic conditions because when people loses the jobs, when the corporates fire people and all those kind of scenarios happen, that's when the actual conditions in the economy worsens, which impacts the pricing power, which impacts the purchasing power and all of that. So we need to understand stock market as a leading indicator. It might sound counterintuitive, but it is the best at this juncture to invest in stock market. Especially if you're not aware of picking stocks, the best way to do that is to wait for a potential further correction of 10-15%, but start deploying the cash right now because the market is appearing very cheap with respect to the potential economic conditions in the next 5 to 10 years over long periods of time. These are the best conditions that you get cheap prices. Now, here is why I'm saying, look at the purchasing power of US dollar over 100 years. Here is a $100 bill that you can see. If you take from 1920s, a $100 bill is gone down to, it's worth only currently $3. If you take 120 years history, if you take $100 in the year 1900, and if you take the same $100 bill, currently it is just worth $3. It has lost 97% of its worth. That is how the purchasing power of dollar goes down. And to add to the woes, we have so much of money being pumped into the economy, which even worsens the purchasing power of dollar, So the currency is losing its value day in as we keep looking at the future. So what we need to do to beat the inflation is to look at an asset class that can beat the inflation. Look at S&P 500 index. The returns inflation adjusted over 100. It's inflation adjusted. You have to keep that in mind. After adjusting for inflation, if you take the value of S&P 500 over the same 120-year period, something that started at 200-250 range, after inflation adjusted, it's currently the same thing is worth around 4,000. That's up almost 20 times after adjusting for inflation. Whereas the value of currency is depleting or is gone down by 97%. You take if the inflation that is out there currently at 7% or 8%, eventually it will settle down at 3-4%. But you need to look at an asset that can give you returns more than 4% to retain your purchasing power. So the asset class should ideally return somewhere around 7, 8, 9% so that your purchasing power remains intact and you can increase your wealth effect, right? So S&P 500 on an average has returned close to 9 to 10% over long periods of time. That is a condition of approximately 10-year time frame. Now, if you take a 20-year time frame, the certainty of getting a 9-10% compounding is close to 95 to 100%. If you take a 10-year period, that comes down a bit, but it's still above 80%. So you need to look at an asset class that can return, beat the inflation which is at 4 to 5% currently. Now, here is what the power of equities and compounding can do over inflation. Invest in appreciating businesses that can outbeat inflation over long periods, can help people stay beyond the purchasing power or above the purchasing power. Today what you have, you need to retain at least that 10 years, 20 years, or you could go beyond that. That can happen only by investing in appreciating assets like equities. Power of compounding when done over 20-30 years can really create wealth. Even if the rate of return is just 10 to 11%, it can be humongous wealth. Investing in depreciating assets can put ourselves on a treadmill that takes nowhere against inflation. For example, a 4% yielding bond can just maintain your purchasing power against a 4% inflation. That doesn't take you anywhere. It's like running on a treadmill that takes you nowhere. You feel you're moving. Equities returns are not only through capital appreciation. In the beauty of equities is it also gives dividends. Many companies pays dividends. At least 1%, 2% you can get as a shareholder from these companies. So that adds up to the compounding. You should hold only so much cash. Always, cash is not, you should not hold everything in cash. You should hold only so much cash that can cover up to 2 years of expenses, including contingency, and the remaining is ideal when invested in equities. It's sufficient if you cover 2 years of expenses, annual expenses. That much of cash is good enough to deploy. Whether when the market goes further down, you could even use that cash. But beyond that, it doesn't make sense to hold that in a cash or in any other asset class better than equities. So just wanted to bring this up so that people can take advantage of the falling stock prices and invest and gain advantage from the power of equities and the power of compounding. Trust this was helpful. Thanks for staying with me. Signing off, Sandeep, Anand.